Hello everyone and welcome to, as I said, the third webinar of the day. I know some of you have been with us for both sessions on Forex, which is lovely to see you here, and some of you are joining us for the first time. In this session, what David and I cover is, we've called it the day trading, which is basically, it really boils down to the indices. Sometimes we look at the commodities, but in all honesty, we tend to focus on the futures. Although, having said that, the lessons that we explain here, how we cover the markets, are really applicable to any chart, really. But before we start, as usual, we have to start with a disclaimer that I know you can see on your screen. All trading in whatever market can be is inherently risky, and so please don't ever use money that you cannot afford to lose. Right, let's go. Carry on. This is myself, me, and David, and we will be looking at the charts through the prism of volume price analysis. I know we have attendees who come along who've just bought the books, which is fantastic, and they want to know a little bit more how to apply volume price analysis, which you can apply to any market and any time frame. As I said, the ticker, the symbol at the top left hand of the chart, I'm not saying it's irrelevant, but you know, give David and I a chart in any time frame. We don't really need to know what it is, and we can talk at it and explain the principles of VPA as they appear on that chart. But we are also supporting that with the quantum trading tools, which we have developed specifically for our own trading and investing, all the markets. But in this session, we use the tools that but don't include the Forex ones. The VPA, the volume price analysis, this is the book where it's the first book, and it really covers the basics, explains it, the principles of the methodology. The methodology is nothing new, and we don't claim that it is new. It takes what has gone in the past, primarily from the work that was done by Richard Wyckoff, but the VPA elements, the 5 pillars of VPA, that is pretty much our own, for the simple reason is because we have included candlesticks and candle patterns. I'm going to talk about candles and candle patterns in this session because looking at the YM, and funnily enough, the YM really had kind of follows on from what we covered in the 2 previous sessions, looking at inside day candles. So everything sort of has come together rather nicely, but more by accident than design, I can assure you. So you can read about it. As I said, it's up on Amazon, both in Kindle and in paperback. What we've also added to it is, and you can buy it as a little bundle, is you have the original book, and it also has some worked examples. There are 200 worked examples, and although it says actually the using stock trading, that particular book does actually include the examples taken from the indices, David, commodities, and in all time frames. So whether you want to trade or invest, there is a time frame that will cover that as well. And as I said, the principles, the examples in there, what to look for on your charts, they appear in, as I said, across markets and across instruments. As I said earlier, we've developed a specific set of tools for what we call day trading, the futures and the cash markets. In these tools, there are some tools which also appear in the full package, which covers the Forex markets, but there are also tools, non-time-based charts, particularly tick and Renko, because as you're day trading, especially fast-moving markets such as the ES and the NQ, you know, time charts, sometimes they're just too laggy. You really have to get in when you're aiming for a small number of points. You want to get in there and come out there very quickly, and David will be explaining how his setup and how you use them and how you incorporate them with the time charts as well. And all our indicators are all covered by a 7-day money back guarantee, and they come from what we've called the essentials package for Ninja Trader. This is the total cost of the package, 749, but you can buy them individually. You don't have to buy the full package. You buy 1, 2, there are bundles there, and if you then decide to upgrade to the full package, you'll get a credit, so sorry, you'll always be credited for what you buy if you upgrade. All upgrades to the indicators are free, and this is the site where you'll find more information, which is at quantumtrading.com. Now you can see there we've got MetaTrader, NinjaTrader, and TradingView. And as we mentioned this morning, we're literally working on we're finally working on porting them to TradeStation. I've been in touch with TradeStation, and we hope to have these done as quickly as possible. This is my own site where you can catch up with my own analysis. I also have various Facebook pages. There's a Forex one, there's my own personal one where, as I said earlier, you can get the thoughts of Chairman Cooling, my take on what is happening in the markets generally, just interesting links, etc. And there's also a stock page there and a commodities page as well. And I think, oh, and if you want to contact us, I'm doing all this at the front because by the time the end comes, we've usually forgotten about it. If you need any information on anything, you can just email me, anna@annacooden.com. On the quantum side, there's help desk at quantumtrading.com. Jonathan there will be more than happy to help you, or David at quantumtrading.com. That is it. Anything you want to add to that, darling? Have I missed anything? David, that's it. Okay, fine. Let me just clear that out. Right, here we are. I've got the YM. I've got Ninja 7. David has 8. I just keep saying I'm going to go and sort out Ninja 8, but I still haven't done it. And I think at this rate, I'll probably just move straight to TradeStation, quite frankly. It's a platform that David and I actually did used to use a few years ago. Right, now, what we were discussing with regard to the Forex market, in particular, one of the pillars, as I said, of VPA is candles and candle patterns. And the candle pattern that I really wanted to, that I've been focusing on the previous 2 webinars is what is known as an inside day. Basically, when the price action, the current price action has retreated back into the spread of the candle. And by coincidence, this is the daily chart of the YM. We have some really nice examples. We've got one that's going on at the moment. We had one the other day, and we have this one when the volatility was triggered. We know that because that price action on that candle was outside the average true range, and what generally happens is it creates a kind of its own inside day. We've got another one here where that was another volatility, not so much on with this one, but the interesting thing about inside day candles, you can read about it on the you can look it up on Google as well, is is it a candle pattern that is a continuation pattern, or is it a potential reversal pattern? And the studies that are being done, particularly by Thomas Bukowski, it's not a 50-50. It's if anything, I think the bias is more towards possibly a reversal. And they're also important because you also have to take note of what is the candle that precedes it. So for example, here you have this big down candle. This was yesterday, big sell-off in the Dow again. But towards the end of the day, you know, a lot of selling came in, as you can see here, as denoted by the wick of the candle, and so the price has opened within the spread of this candle. Now what happens is inside day, particularly if you have a series of them, so you have this candle as your benchmark, and then the subsequent 3 or 4 days, it never breaches the high or the low of the candle. It is kind of an indecision. It's the market really can't decide. There's been an explosive movement one way or another, and it really can't decide, you know, where it's going to go. And as a trader or an investor here, what you have to do is you really have to be patient, because really the market hasn't made up its mind. And going back to this one where we had volatility, we had this big down move, and then suddenly this snap back into the spread of the candle. And yes, it did look as though it was going to clear the top of that candle, but then what happens, it runs into a very strong area of resistance, because you do have to, whilst the candle pattern is interesting and your eye is drawn to it, you know, the way our eye is drawn to maybe a shooting star or a hammer candle or a 2-bar reversal, all the other elements of technical analysis come into play. And certainly from a VPA perspective, you then have support and resistance, and you also have to look at the volume on the histogram to see whether this reversal is actually going to be supported by volume. And why we have this nice widespread up candle, volume wasn't fantastic, and then boy, it ran into the resistance here. So, you know, you could say there was a kind of reversal, but it just couldn't carry through. And in fact, it's also over this period of time, we are looking at the volume point of control of itself, if you like, a value area, the fulcrum of this chart, where during this period, markets participants were just transacting amongst themselves with no clear or firm direction. Now, the reason for, you know, why are the markets behaving in the way they are? They've certainly been volatile, and as I covered this earlier on, we've got the issues with China and the US on the trade tariff front. We've also got another issue coming up behind us with Italy and the problems that they are running their spat with the EU, and they want to increase their deficit, and they can't because that would breach the fiscal rules. But you know, so that's another sort of landmine that's waiting out there, possibly to blow up the markets. And you've got Iran, so you have a lot of political risk affecting the markets, much more so than certainly David and I remember when we first started. Now, what's also interesting is all the news is out. We've had the preliminary GDP, which didn't actually generate as much volatility as we had expected. It was a reasonable number, as expected, which is probably why. But we've had since then the pending home sales, which you can see here have not come in, you know, they come in much lower than expected, much lower than previous, and below expectation, which tells us that the housing market is also slowing. So if you like, it's building up a picture, particularly for the Fed, as to what they are going to do in relation to interest rates. So this all has an impact on what is likely to be happening in equities, and you know the bond yields have been falling as well. So it's not looking, you know, terribly positive for risky assets. But what also was released this afternoon, and it's not normally on Forex Factory, is this data, this piece of data, the where is it? The deflator, the PCE. Where's it gone? Where's it gone? I've lost it. Here we are. The PCE. These metrics here are the metrics that the Fed pay a lot of attention to. It's the personal consumption figures. And basically, if personal consumption is falling, then it tells the Fed very clearly, as well as all the other indicators that are out there, that consumers aren't spending. And if people aren't spending, why? Maybe they're fearful. Maybe this talk of, you know, whenever you have war in a sentence, people get nervous. It may be a trade war and it may be a war of words, but it is still a war, and it makes people uncertain. So what happens in uncertainty? Money flows into safe havens, which are bonds, gold, although I don't think gold has done anything too spectacular lately. But, you know, we shall wait and see. Meantime, for day trading, all this is background stuff. We still have to look at the charts and basically be aware of what's going on in the background, be aware of the landscape, but trade what you see in the chart. Because if you listen to the headlines, you think the world, you know, the sky had fallen in. What happened yesterday? Had a huge amount of buying coming in. As a trader, you don't really care. You just want to get the direction right, so you can, you know, make your money whether the market is going up or going down. Anything you want to add to that, David? Thank you very much. I will now pass over to my other half, and we will see what are you looking at? Are you looking at the YM, or you've got the NQ? What have you got up? Okay, fine. We'll look at it on the certainly on the faster charts.
Just switching screens. Just click that one. You should be seeing my screen coming up now. Yep, that's great. Okie dokie. Just move that out of the way. Just while Anna was talking, I've been obviously looking across the primary indices, the YM, which I've got running here on the various timeframes. Very fast time frame up at the top left. This is 15-second, and part of the reason I have that is because when markets are in congestion, which we've got right now, then picking out trades on anything much slower is difficult, but it also does not automatically imply that you have to trade at that sort of speed. It's there if you want to, particularly on NinjaTrader, you can go down to this sort of level of seconds. But moreover, when markets are in congestion, it is one of the ways of finding the opportunities to trade thin that they may be at the moment, and perhaps not what suits you particularly temperamentally, which I would entirely understand. It's not for everybody. It's extremely quick. You've got to be in and out fast and not hanging about at the moment. And part of the reason for that, clearly, as you can see, this is on the 15-second, this is the 3-minute, this is the 5-minute, really dominated by the volume point of control here, the yellow fulcrum of market price agreement. So there is nothing much happening at the moment. The fundamental news has gone through, down onto the daily. That's where we are at the moment. The market has ticked up. We had some buying coming in, as Andy said yesterday. That came in on that on the late recovery. So there was buying in the market, although not particularly strong. Sentiment at the moment is pretty bearish. It's not, any recovery is looking rather fragile right now. And from a technical perspective, at any rate, we've got these very strong levels, certainly as far as the YM is concerned, in terms of ceiling of resistance here. We've got the VPOC itself up here, further resistance up here. So any recovery is going to be a hard graft, plus you've got a ton of volume sitting in this region here. So any recovery in the short term is going to be hard work. That's just on the YM. The others are very similar to that, although not identical. Just keeping an eye on what's going on at the moment. Hopefully we'll get a move away at some point and a stronger break away from the current congestion phase. That's already just confirmed. This is down onto 15. This is the market open. This is Globex, as you would expect. We get the inrush of volume as the cash market opens up with the futures market. So we've got the two running in parallel. Big surge in volume, what we always get at the open, often accompanied with volatility, as we have here. And we've just got a whole series of indecision candles, one after the other. We've got three, long-legged in the middle. That could almost be classified as long-legged. Another doji to follow it. So the market is in total indecision right now with regard to the fundamental news that's come and gone. And in addition to that, we've also got the big news of China, which is overnight, I think, tomorrow, which will influence all these markets hugely. There will be a massive reaction to it, whether it's good, bad, maybe not so much if it's pretty much as expected, but certainly if there's anything to the upside or downside, then these markets and risk sentiment markets in Forex will react strongly. Got a volatility trigger coming on the 15 seconds, so we expect a bit of sideways off the back of that. Let me just head over onto the indices where I've got the others running, which is this one, I think. Sorry, I set these charts up yesterday just to refresh them a little bit. Yeah, basically what we've got the YM here at the top left, we've got the NQ in the middle, and we've got the ES over on the right-hand side, and they pretty much mirror one another. You can see here we've got the volume point of control is in sharp focus in all three. We're trading around it, trying to break to the upside at the moment. The attenuation in volume that you see here is pretty typical. You get the big surge around 2:30 our time, market open, for the next few candles, and then gradually it starts to settle. So this fall away in volume is not symptomatic of a decline in interest. It's just symptomatic of what happens when the floodgates open and you get this massive inrush of volume, and then gradually that settles into the market momentum. That's not to say you can't compare this with this, but just remember that these four candles here, or these three or four at any rate, are certainly the inrush of volume as the market gets underway. So three of them are pretty similar, trying to move to the upside, and you can see that the daily candles pretty much the same to the downside as well. But again, the volume point of control is in evidence. We've got it here on the NQ, we've got it here on the ES, and over on the YM. I referenced this in one of the Forex sessions. It really does highlight what the market's got to battle back through. It's got to battle through this whole area of volume in terms of the volume point of control itself. And in addition to that, we've got these very, very strong levels of resistance now in overhead. They were acting as support. They're now resistance. The thickness of the line, this is the accumulation distribution indicator, which actually develops these lines in real time. So Every time a level is tested and it holds, then the thickness of that line will get ever thicker. So the thicker the line, the more dense that area of resistance or of support. It's as simple as that. These levels down here, which are relatively thin, whilst they are there, they're important, but they're not going to be as strong as these guys here. And that's the way the indicator works. It's all based on price. Let's just head back to the other workspace. We're going to multiple time frames. I'll hop over onto the tick charts in a minute. Drop that out the way. Still not moving anywhere. Still trading in a range. Constant efforts to rally. And even on the 15-second, you can see the weakness that comes in. We had the volatility, few candles inside, that's what we expect to see. Then we tried to rally, then we had a surge in volume on this one, and weakness, big wick to the upper body. Is that a sign of strength? No, it's a sign of weakness. Next follow through, volume drops away, then we have a trigger to the downside, volatility, ton of volume coming in under it, so the big operators are in there. Market sideways now, we're tracking back down to the volume point of control again. Trend monitors transition. We had this brief rally here on bullish. Trend lines dived below the fulcrum point here at 0. This comes with the trend monitor, the trend line, so you get two indicators for the price of one really, and you can either switch it on or off. But it just gives a sense of strength of trend, steepness of the line, how far that trend has moved away from the midpoint, the fulcrum here, and therefore the possibility of maybe a bounce and reversal. You've got a level in here of potential support, reasonably strong from the thickness of the line. We're at the VPOC. There's actually another level sitting immediately below the volume point of control here. You may or may not be able to see it, this dash blue line, which is even thicker. That's actually provided some support for the time being, but now we're testing this level here. This is pretty strong, acting as resistance. If we get through there, it becomes support. And that one went in because the market hit that level and bounced off. So we've got a very minor level here. It's been tested and held once. If that's tested again and it held with the same sort of candle and bounced off that level, then it would be increasing to 2 and so on and so forth. Let's just pop that down. Let's go up to a slightly slower time frame. Let's just pop that open again. Sorry, something caught my eye. Okay. Again, if you notice, this is VPA at lightning speed. But when you see these sorts of candles, you've got a rising market, you've got rising volume. That's fine. Then you get this drop off in volume here. You know, the market is not interested in the upside. Tiny volume to the upside. Now we're starting to see rising volume to the downside. We're testing this platform here I mentioned earlier on. May or may not hold. We've got rising volume. You can see it here. So all these, what you're seeing in real time in a very fast chart, can be demonstrated and applied in any market, any time frame, from this right the way through into the hours, the days, the weeks, whatever is your particular time frame of choice. Let's just go slightly slower, calm things down a little bit. One of the issues that, particularly when markets are trading in these congestion zones, is first of all patience. It goes without saying, something none of us are very good at because we want to be trading and not sitting here watching a chart for hour after hour after hour. So if patience is not one of your strengths, it's probably best at this point maybe to walk away for 5 or 10 minutes, then come back, see if anything's developed. If it has, fine, you can jump in or do whatever. But one of the things that is important if you're going to sit in front of the screen is actually come up with some levels. Just move that out of the way of the chat box. Is actually to try and lay out some levels where you think once the market moves through that region, then that represents a potential opportunity for you. And this is probably a reasonable example of the sort of things you have to consider, because it's all very well thinking about a level where you may or may not decide to get in, but then what is below that level and what is the opportunity that potential trade may deliver? I mean, looking at this this chart, which is perhaps a simplistic example, but if you said, well, actually, do you know what, I think once the market breaks through here, I might consider jumping in. Well, you know, do you really want to be jumping in when you've got this massive price action over to the left-hand side, and more importantly, a ton of volume, which is actually increasing on the volume histogram? In addition to that, you've then got some very heavy support here, which could come into play, and a further level here. So for the sake of making whatever this is, you know, 170 to 140, 30 points, which, okay, on the YM is, you know, $150 or whatever. Does that represent a reasonable analysis of what's going on right now? And would you be comfortable taking that position in the market given what is going on in the immediate area to the downside where you will be trading ultimately? Personally, I wouldn't. And so you go off and look for perhaps another area or a level further away. If you go up to a slower time frame, go up to a 5 minute, for example, it's a similar sort of picture on the 5 minute. Once you break below this sort of region, for example, at 175, maybe down to 170, you know, got a ton of volume in here, a lot of price action in here as well. And really, for the market to move in a meaningful way, certainly to the downside at any rate, you want to be looking at a level well below that. And you might say, well, that means giving up a potential load of that particular trade. Well, that's true, but then, you know, it's a question of making a judgment call as to how the price action is unfolding at the time. That's where we're trading at the moment. Pretty narrow, just widen that up a little bit. The market may well move in this range all day. You have to accept that, and it's part and parcel of trading indices. You can trade them obviously outside the cash market hours because it trades 24/7 pretty much on Globex. But if you're only trading indices and the indices are going nowhere, then you've got a decision to make. Do I trade something else because you want to trade through boredom, or am I just focused on what I'm doing with, you know, I am an index trader, or I'm an oil trader, or I'm a gold trader, whatever it may be. 15-minute chart really sums it all up. Doja, 3 dojis in a row. Might get another one after that. And if I just hop over onto the tick charts, I've got the Renko here as well. And as I'm sure you know, the Renko is non-time based. And what we've developed with the Renko is what we call the Renko optimizer, which essentially gives you the optimal brick size for that particular market. So I've got this on the YM, and this is delivering 13 at the moment. And that will change depending on the instrument you're using and the time of day, because it always changes throughout the session. But the beauty of a non-time based chart, the Renko is one, tick chart is another, is when the markets are moving, you will see that momentum revealed in the chart itself. These are the tick charts. I've got 3 tick charts here. At the top of the frame, I've got this is on the ES, and this is the daily at the top, and then we've got the 3 tick charts here. And what the tick speedometer does on the left-hand side here, again, it's like the Renko optimizer. It's delivering the optimal tick speed for this particular instrument on a 1 minute, a 3 minute, and a 5 minute time horizon. It does other things as well, but these numbers down the side here give you the optimal tick settings for your tick charts, because otherwise, how do you know what it is? And I can tell you right now that these tick settings for the ES are really low. This is a real sluggish market right now. It's very slow. This should be in the thousands, this should be in the several thousands, and this can be up into the 20,000s when the market's really fast moving. So that gives you an indication. What also gives you an indication is the color change here on the tick speed, which is flip-flopping between red and orange. And when it's in red, it's very low. There's no participation. Markets are sluggish. So you expect to see sideways price action. Orange is the default, the sort of average, if you will. And green is when you get pulses of price action with tick activity jumping on that as the market picks up in terms of participation. So the ideal for trading is obviously orange and green. That's what we're looking for all the time, to get into those positions where we've got good participation then the markets are actually moving. And when they move to red, it's flashing a warning to say these markets are really slow and sluggish. And that changes all the time up here on the fast, medium, and slow. That gives you a heads up as to exactly what is going on in terms of market momentum. Let's just go back to the time charts again. It's just looking very, very fragile, the market at the moment. You get these attempts to rally all the time. Tries to rally. Bit of support coming in there. Doji tries to rally again. Big wick to the upper body. Bit of support coming in on the VPOC. Effort to rally, falls away. Down to the upside, trying to rally again with these candles. Get up here, then we get a bearish engulfing. Down to the downside again. And then these down candles developing here, tried to rally, fallen back. Tried to rally, fallen back. You know, it's not a good sign at all. You can also see the trend monitor is going through the transitional colors. It's gone out the back, came back into blue temporarily. Now we've gone back out the other side. We're back into dark red. And if this goes into full-blown reversal, then that will change to bright red and ripple through across the time horizons. Where this is likely to pause, certainly at this level where you've got a strong potential platform in place. So we've got another 7 or 8 points to go there. Then if we breach that, we've got all this price-based congestion here as well. So we've got to get through that lot. Check out the volume as it goes down. And then if it gets through that layer, then it's got this one to contend with below. But then if the market breaks, generally what you see in a price waterfall is it will take these levels out comfortably, because markets generally fall a lot quicker than they ever rise. And the reason for that is because the insiders, the market makers, want to get there in a hurry. And on the uptrends, they're taking their time, maximizing their profits. Put that down there. Let's have a look at the 15. At least got a couple of candles on here. Again, it's just signaling weakness. You've got the doji, another doji. Then we had the effort to rally. Not a lot of volume under that one. Decent volume under this one. We'll just see how this one develops. Where are we going back to? Well, the first port of call should get through this slice of volume here. It's pretty lightweight at 160 odd. If it goes through 160, then we'll probably stop and pause point at the 140 on the VPOC. Possibly come out the other side down to 120. 50 points in there. And just going back to what I was saying earlier about the way these changes ripple through the time frames, you can see it here on 15-second. The trend monitor has been bright red for some time. It's got a little bit of a transitional color here because we've gone into congestion, but nevertheless it's been red for some time. This one is only just about changing, as is the 5-minute, and no change on the 15, which is what you expect to see. But if this translates into a decent trend lower, then this will change color to red. This trend line will dive below the fulcrum. This will start to dive below. This will change to red, and this will start to change to darker red or maybe darker blue, maybe go through the full spectrum, or it might transition very quickly. Sorry, just going to switch off. Cold selling on the phone. Sorry about that. It's developing nicely now, the move. You can see the transitional changes happening literally before your eyes. Got through this level pretty swiftly. Given there's very light volume here, we should slide through there relatively fast. Yep, it's going to test it, get through it. Okay, we're down to 132. Nice points now building. Rising volume on those last two candles, and we've got some buying coming, and this is 15-second, remember. So we've got some buying coming on that candle, the wick there, and lots of volume underneath. Now starting to test that level there. Drop off in volume. See the selling volumes just dropped away there. So we've had high volume, low volume. It's in agreement with the candle though. This is the one that sticks out a little bit. We've got volume falling away now. See if this continues or not, or whether it's going to run out of steam. Nice big widespread candle on the 15-minute. And it's, you know, you've waited for this moment, and it's a question of where you set your levels and at what point you want to get into this market. Now what's interesting on 30, just pull that up, there we go. We've got volatility triggered on 30. This candle hasn't closed off yet because we've got another, how much longer have we got to the half hour? Darling? What's the time now?
We've got the inventories coming out, haven't we?
Yeah, how long to the half hour?
7 minutes.
Okay, we've got 7 minutes to the half hour. The volatility is triggered already, which means that this price action has moved outside the average true range. What that's telling you is that the market makers are participating. They're involved in this heavily. They're moving the market very rapidly. They want to suck traders in. That's their whole remit. They want to suck traders into weak positions, and then they'll reverse. So as soon as you get this indicator triggered, it triggers on the condition having been met, not on the close of the candle. So as soon as we move outside average true range for this particular instrument in this particular time frame, then the indicator is triggered, and you know for a fact you've got volatility and market maker participation. Thereafter, if you're in this trade, you've got a decision to make. Do I close out, bank my profits? On the expectation of, at the very least, some sort of congestion phase to follow. It doesn't always follow. It didn't follow here, for example, but generally it does. And that's the decision that you have to take at that point. Do I bank what I've got, close out, waiting for the price action to move away from that particular candle and develop the trend further, or do I just sit it out? Am I prepared to wait, sit through congestion, possibly even a full-blown reversal, certainly back into the spread of that candle and maybe to the upside? That's the decision you can take. We've now got volatility on 3, so we're expecting a reversal on 3. We've got volatility on 5 as well, so we're expecting a reversal there as well. So you've got 3 whopping great signals telling you to expect a reversal, which is exactly what we're seeing. That's the power of the indicator. It will get you out of trouble. I was going to use a quote from the Italian Job, but it doesn't come to me quickly, but it's something like that. It's to do with driving cars. No, it's to do with the driver of one of the minis, I think. It says this guy will get you out of trouble. Sorry, I digress. So the trigger came in here. We've now got the trigger on 15. We've got 30. We've got a volatility on every single time frame other than the very fastest of 15 second rather. So we've now got the price reversing, which is what we expect to see. And as I made the point in real time, when you see that coming in, if I'm trading and I see that coming in, the first thing I do, if I've got decent profit in the bank, I close out, because I don't particularly want to sit through a reversal. I'm quite happy to sit there, wait, be patient, wait for the market to develop. If this is going to develop further to the downside, then once it's cleared that region, fine, I can jump back in again. The cost of trading is peanuts, so it makes no difference. So I'd rather bank what I've got and get out. The difficult decision is if you're sitting on a loss, for example. That's harder. And again, it just reinforces the fact that if you're using multiple time frames, you have all the information at your fingertips, so just use it. If you're on a 15-second chart and you're trading that in isolation as a scalping trader, and you're not looking what's going on in 3 and 5 or 1, 2, 3, whatever it may be, it's crazy because you'll get these signals all the time. If you're sitting here now thinking, oh, why did that reverse against me? I've just lost 20 points here. You know, maybe you're moving back up to your stop. So maybe you had 50 points, you've lost 20, your stop's quite tight, or you've moved your stop down, you get taken out. It's just not necessary. That's assuming you're using the indicator, of course. And that just reinforces where we are on the daily now. You've got this effort to rally. We got up to nearly 200. Now we're back down at 122. And it's just looking very, very fragile, the market. It could roar back tomorrow. If the Chinese data is terrific, then the markets will react accordingly. However, what they'll also be tempered by is the US fundamentals, which are not terrifically strong. So any reaction to China may well be capped by a realization that the US markets are not perhaps as strong as the Chinese markets, or the Chinese market may be presented as. Let's put it that way. Now we're back in patience mode again. Volume point of controls moved down. It's at 128. This moves around the whole time. It's completely reliant on how fast the volume profiles build and rebuild, how long. It's all to do with time. The volume point of control is about volume, price, and time, because it incorporates time into the linear relationship, if you like, between volume here and price, which is a very linear one. It introduces time whereby it reveals the depth of volume, which is sitting in all these various regions, because you're basically bringing it up onto the y-axis and presenting it in that way. So you then see visually where you've got these very deep regions where the market has been in congestion for the longest at the VPOC, the shortest where you've got low volume nodes, and then you've got higher volume nodes up and down the histogram as well. So it gives you a complete picture, a very simple graphic of where you've got these concentrations of volume, and using volume in exactly the same way as you would price-based support and resistance, which is what these levels are all about. So it's using both. Any questions?
I'm just doing them now.
Okay.
Lisa says, if we were to have a huge crash like 2008, will these cycles still go on? Will you be able to continue on with your VPA and business as usual? Could you ask her, is she referring to our business?
I don't know.
What I was going to say was, yeah, great.
If you were to have a huge crash, sorry, I've just got the question from Lisa. If you have a huge economic crash like we did, will these cycles still go on? Will you able to continue on with your VPN business as usual? I'm not sure whether you're referring to us as our business or whether the whole business of trading. The business of trading, we will still be here. The business of trading still goes on 24/7. Whether it's a huge market crash, in which case there'll be volume will be extreme, volatility will be extreme. I suppose the one anecdote that I can reference to that is that Jesse Livermore made all his money, or a large percentage of his money, in the crashes, and he was actually hated for it because he was seen as the not the instigator, but certainly someone who benefited massively from everyone else's losses, and that's where he made the bulk of his money. He ultimately lost a lot too himself, but he was shorting the market like crazy. And indeed, the night he got home, certainly one of the biggest days crashes, the night he got home, his wife thought that they'd lost everything and she was prepared to leave the house and everything else. And he had to tell her, look, I've made more money than you can possibly imagine. So it doesn't matter whether the market's crashing or the market's just meandering or what it's doing. The volume is volume. Volume will always reflect the truth behind the price action. It's as simple as that. So I hope that answers that one for you, Lisa. Whether we will be here, we will always be here. because you know, we trade with stocks and all the rest of it, and whatever we're doing, whether we're in stocks or commodities or indices or forex, the same, we apply the same sort of style and approach. Nice run to the downside, rising volume, falling price. That's what you want to see. That's just confirming. It's confirming the bearish picture. This is 15-second, but it could be a minute, 3 minute, 5 minute. Doesn't matter. When you see this rising volume, falling price, it's confirming the bearish nature of the price action and just saying, yep, more to come. Nice heavy selling in that candle, little wick to the bottom, so nothing much to do in terms of buying coming in on that particular candle. More to the downside. Expect the market to move deeper still. Higher volume still on that one. That's an interesting one, and you know, a relatively narrow spread candle. So that implies a lot of volume going into a market which is resistant to a price move higher. In other words, selling into a compressed market. That's in agreement. Nothing too much to worry about there. Let's go over onto the slightly slower time frames. Still trading within the volatility candle, just trying to move outside now. We had sideways on here, 5 minute, trying to break to the downside. Let's go down onto 15. Yeah, still trading in the spread here. And if you're looking for an opportunity to get back in, then it's a question of really waiting and being patient and waiting for a candle to close below the lower level of the candle that was the volatility trigger. Sorry, I'm just going to switch off for a minute. Dogs have kicked off. Apologies. For those who come along regularly, you'll know we've got 2 dogs here, and they love to join in occasionally. I'll just switch off for a moment. They've quietened down now. No, sorry, I was wrong. They're quieting down at last, almost. Oh, I'm sorry. I think they finally quieted down. Apologies, almost. While that was kicking off, just updated the tick charts here, picking the numbers off here. 1597 tick on this one, 2584 tick on this one, and this one's still running at 2584, which is very, very sluggish indeed. I've got that at 2574 at the moment. But you can see the indicator's working exactly the same way. I've got the trend monitor running on all 3. It's exactly the same principles as you would on a multiple time-based workspace. But the difference is that clearly on these charts you will see momentum. As the market speeds up and slows down, you will see that momentum visually on the chart. The candles will build in real time very, very quickly, because the governing factor for a tick chart, as indeed a Renko, is not time-based. This is governed by the fact that 1597 ticks have gone through. Once that number of ticks have gone through the chart, then the candle will build and on to the next one. Now that could happen in nanoseconds, microseconds, milliseconds, whatever, or even seconds sometimes. And that's what you see. So you see the constant speeding up and slowing down of the chart and the market in real time. It's visual. It's very, very visual. And I tell you, when you get a significant news release, these really do move like lightning. So it's just, that is one of the beauties of trading on a non-time-based chart, is the momentum aspect. And that's why we developed the tick speedometer down the left here. First of all, to deliver the optimal tick settings, which you pull off here. And you can see as I'm talking, this is now increased. So this is now picking up speed over here. So I'll just update that just as I'm talking. Put that up to 4181 tick. It's very simple on Ninja. You just type it in and put a T on the end. And it also allows us to blend volume price analysis with trading off a tick chart, because what you can see here is traditional volume price analysis applied to a time-based chart, but actually you have the beauty of trading on tick charts over here. So it's a blend of the two. So you can apply VPO over here on the left-hand side, see what's going on, see the buying and selling coming in and out of the market, confirmation signals, etc., etc., and then trading on the tick charts over here alongside on the right-hand side. Just go back onto the time-based charts again. There we go. Let's get that out of the way. Still trading in the range of the volatility here, here, in here, and here. The only place that you can say there's trends developing is really on the 15-second. Other than that, you're stuck in a trading range over here. And that's what the volatility does, because the market makers are well aware of the fact of emotional triggers. And what they've done is they've moved the market rapidly one direction or another. You jump in, then you get trapped. And now they're putting the emotional squeeze on through through time, because the longer you're sat here in this trade that's not going in your direction, just going sideways, and indeed looks as though it might reverse, that's emotional pressure. You'll either get stopped out or you'll close out at a significantly reduced amount of profit that you had in the bank before the volatility appeared, or you get stopped out completely at a loss. And that's the power of the volatility candle and what it's telling you and what it reveals, and the emotional pressure that follows thereafter. And that's why I say when these appear and you've got a good position in the market, it is far better to close out, take the profit off the table, and just wait for this period of price action to either continue in the original direction, which it may well do, or if it is a full-blown reversal, to jump back into the reversal once it starts to get underway in the opposite direction. It's as simple as that. I'm just going to switch off for a moment. Okay, we've been going for nearly an hour. I'm just going to pass back to Anna, and she will wrap up. And thank you for coming along today. Hope you've enjoyed it. As always, good to see so many of you in the room. And I look forward to seeing you again next week. But I'm going to pass back to Anna. She's just got a couple of comments to add to what I've been saying. And I will see you next week.
Thank you. Just to go back to the daily chart again, and this is the price action that we've been following on the fastest chart, and again moving back into the spread of this candle. So yesterday's buying, I wouldn't say it's all been in vain, as it were. We really just have to see what's happening with the rest of the session. But as David mentioned earlier, really what the markets will be waiting for now is the news tomorrow. And here we have it here. Let's have a look, where this is the number the Chinese manufacturing PMI, which normally the first week of the new trading month is always PMI data. It's quite unusual to see it on the last day of the trading month. So we will see. It will certainly may set the tone for what is to come next month, which could be worse than we've seen up, so far. Again, we will just have to wait and see. As I said, there's an awful lot of landmines out there at the moment. And I forgot to mention, someone wrote me a message basically saying about the fundamental. There is one other landmine, if you like, that could affect blow up the markets, and that's of course Iran, which is kind of bubbling in the background. They're like characters in a play. They come center stage at different times, but the thing you do have to remember with the news that it's the perfect opportunity to shake traders and investors out of the market. So you have to be aware, but at the same time, just trade what you see on the chart. And sometimes it is completely contra to the noise, if you like, that is going on around you. So it's really being able to distinguish what we call between the noise and the signal. And just to go, here we are. This is the have been going up, but the Dow sort of deflating a little bit. Watch the VIX, still not at 20. 20 is like the sort of key number. Once it gets 20 and beyond, then you get a lot of panic coming into the market as well. Look at the bond yields. Are they falling or rising? Well, they're not crashing basically. So we'll wait and see, and just see what happens, and whether all these issues that we have at the moment, there is going to be some kind of positive resolution. Right, that's all I've got to say. Remains for me to thank you so much for coming along. I hope you've enjoyed it. I hope you've learned something perhaps that you didn't know before. We are back next week. Enjoy the rest of the trading day, the rest of the trading week, and we'll see you next month, because it's June. My goodness, half the year has gone already. Take care, everyone.